Hello, everybody. My name is Leo Kelly. Welcome to the Verdence Capital Advisors 2018 Year in Review and 2019 Theme Outlook. Today we're going to look at 2018's market performance. It was an interesting year. It was a tough year in the markets. We saw quite a bit of volatility and really widespread destruction in the market in the fourth quarter. We're going to talk about what that means. Is this something we should be concerned about? Is this something we should start guarding against? More volatility? Is the market in trouble? Or are we seeing an opportunity? Does this volatility set up a chance for us to make a rate of return in 2019? That's the basic theme of the market. We thought we'd start with 2018, a look at our themes from last year and how those themes performed. So we had four main themes last year. The first was from the Lehman lost decade of growth to a future of organic growth. The concept behind this theme was that the economy was starting to gain momentum, that we were coming off of this consistently low but consistent growth of that kind of 1 to 2%, and we thought there would be some acceleration in the economy. Well, check the box. The economy did accelerate. We actually saw a 4% GDP print for one of the quarters. The economy started to gain momentum. It has started to slow, but we're slowing off of very, very high numbers. So check the box last year, good economic organic growth. Theme two, the great bond unwind is underway, and that we would be navigating through a market where we were going to see the end of a 30-year bull market in bonds. Now again, when interest rates are going down, prices in bonds are going up. So what our thought was in this theme was that rates would start to rise, therefore push down the price of bonds, hence creating the end of the bull market. Well, check the box. Interest rates went up healthy amounts last year. They actually went over, the 10-year went over 3%. It drifted back down at the end of the year. But once again, it's still above the long-term trend, and that box is checked. Finding opportunity in a fully valued world. Essentially, our theme there was that the market, and it did so all year, was trading in a very, very narrow band. A small group of stocks were driving the return of the market, and underneath all of that, there was a considerable amount of opportunity in undervalued securities that we thought we could take advantage of. So we saw those overvalued securities, that narrow band, come down. Now the whole market came down, and so we not only did we see value, but there was even more and more value building as the year went on. Value stocks and undervalued stocks did outperform in the fourth quarter. We're going to give this one a check. This is not a big check. This is a small one. This one was close, but we'll say that it did actually come to pass. And then the big check of the box this time was complacency would provoke the sleeping volatility giant. In other words, our call this year was that after several years of below market volatility and very, very consistent low volatility markets, that we would see this volatility start to come back. And as we know, anytime there's a long-term trend below average, to bring that trend back to average, we have to have above average performance, whether it's stocks or, in this case, volatility. And so the fourth quarter certainly delivered on that theme, and we saw volatility spike dramatically throughout the whole fourth quarter, therefore checking the box. So if the four boxes were checked, then was it an easy market since we hit our themes? And the answer is no. The problem with last year was the really widespread destruction at the end of the year. As we take a look at the next chart, we'll see that all stocks sold off. We saw a broad market sell-off. The big names, the biggest names in the market, large caps, were the least damaged. That would be NASDAQ and the S&P 500. But after that, everything else, small caps, international, all the different countries, really got hit hard. We had a bear market. Most stocks were down more than 20%. The major indexes all came down over 20%. And so this talk about no bear market for 10 years, well, we got it in 2018. Defensive sectors held up. Your utilities, your healthcare, Basically, everything else got hit, and anything that was either financial related or economically sensitive got hit even harder last year. High yield did not do well, so after several years of high yield or junk bonds, riskier bonds, outperforming the broad market, this was the first year we saw those high yield bonds get hit, and only the short, high quality names did well. And then, of course, commodities. Across the board, losses in commodities, and actually some pretty severe drops as well. Putting this in perspective, how bad was 2018 in relative to history? Well, it was an interesting year. Normally what we see is a very volatile September. We talked about that in our quarterly reviews last year. A volatile end of August, September, and usually that volatility peaks out in in October, and we have a rally. This year was different. This year, the market never came back. We never got that Santa Claus rally. In fact, it accelerated into Christmas. And what we saw was the worst December return since the Great Depression. Since the 1930, this was a nasty fourth quarter, and this was a really bad December. How bad was the fourth quarter? It was the third worst fourth quarter in modern times. Only 1987, the great Black Monday crash in October of 1987, and 2008, which again, the second worst bear market since the Great Depression, had a fourth quarter as bad as this. So as we take a step back and we look at, okay, so we had stocks down significantly, and yet not only were stocks down and high yields down and commodities down, but really almost every asset class was down. This next chart shows us, if we look at 70 different asset classes that are tracked, 93% were down last year. So this was a true panic sell-off. Everybody ran for the doors and they went to cash. We saw an illiquidity crash in small cap stocks, bonds, hedge funds did not perform well. So there was no place to hide in 2018. So that is the setup for our conversation going into 19. I know it sounds hard and I know it sounds tough, but when we get these dramatic price reductions and the economy is still performing, which we're about to see it has been, that says to us there's value in the market and we should start to look for that value and place money where capital is scarce. So let's dig in. So looking at our themes for 2019, we have four main themes looking forward. Number one, that the U.S. economy is starting to fatigue a bit, but it's not done yet. In other words, yes, the U.S. economy is slowing. It had to slow. We had tremendous stimulus in the economy in 2018. We saw a dramatic increase in growth year over year. So the fact that the economy is slowing is almost expected. That doesn't mean recession, though, and that's the distinction. Remember, a recession is negative GDP growth for 2 consecutive quarters. And so a lot of the hand-wringing in the market today is because the growth is slowing, but there is still growth. Theme number 2, don't fear the yield curve. Be flexible with your duration. In other words, the yield curve is if you take a 2-year bond and then a 5 and a 10 and a 30 and you plot the interest rates, they usually go up gradually and it creates a curve. And so that curve normally starts low and goes high. As that curve starts to flatten, that means that long rates are becoming the same as short rates. And sometimes it inverts. When it inverts, that means the long bonds actually have a lower rate of return than a short bond. Well, that's illogical if we think about that. If I'm going to tie my money up in a bond long term, I want a higher interest rate. What does that mean? When we get an inverted yield curve, it's the bond market saying, we don't believe in the future growth of the economy, so much so that we're going to discount those interest rates. There's been a lot of fear around an inverted yield curve and a flat yield curve this year. And our message is not to fear that yield curve inversion, that we think that that is a product of a Federal Reserve being aggressive and trying to unwind a balance sheet, not as much an economic event. Theme number 3, after a short break, the bull market should resume. So we had this terrible fourth quarter. We had this terrible December. January is off to a good start. volatility we don't think is going away. It doesn't mean we won't retest some of these pullbacks, but we think that the bull market is ready to go again. Maybe not as hot a market as we've seen in the last couple of years, but we do think positive. And a brighter alternative year ahead. Alternative investments really had a mixed year. Private equity did it pretty good this year, as it has year in and year out. Although, again, with private equity, you're limited to seeing performance to when those private equity funds actually mark a portfolio or set price. It doesn't happen very often. With hedge funds and commodities and long-short funds and real estate funds, everything else in the alternative world, they did not have a good year. And some of this liquidity issue and the mass damage that was done across all these asset classes had an impact on alternatives as well. So while we look to those alternatives to hedge risk, they did hedge risk, but they didn't provide the positive returns you get in some bear markets. So we think that was an anomaly, and we think alternative investments look like a good place to have money going into 2019.